Welcome to WCS Money Tutorials. Today's topic is tax loss harvesting and the wash sale rules. How to save money in taxes by realizing investment losses. Tax loss harvesting in taxable accounts is used to reduce taxes for securities deemed unlikely to yield a profit or to yield less of a profit than other potential investments. Or if you simply want to reallocate assets, you can sell unprofitable securities, especially at the end of the year, to realize a capital loss, which can be used to offset taxable capital gains, or up to $3,000 of ordinary income, including income earned from work. However, tax loss harvesting does not work in tax-advantaged retirement accounts because taxes are only paid when money is withdrawn from tax-deferred accounts. For Roth accounts, there is no tax, so there is nothing to offset. Besides lowering taxes, there are several benefits to tax loss harvesting. Security proceeds can be diverted to better investment opportunities. Taxes can be saved by decreasing capital gains or up to $3,000 of ordinary income, and by possibly increasing certain tax credits. Unused losses can be carried forward indefinitely. The eligibility and amount of most tax credits depends directly on modified adjusted gross income, or MAGI, which is simply AGI with some deductions or tax credits added back. The exact definitions of MAGI depends on the tax code providing the credit, but the definition of MAGI for any of these credits does not include adding back investment losses, so tax loss harvesting will only reduce MAGI, not increase it. Most tax credits have AGI limits with phase-out ranges. This is a simplified schematic to illustrate this general idea. In regard to income, these tax credits are maximized when income is below the phase-out range, eliminated entirely above the phase-out range, and increased with decreasing AGI from the end of the phase-out range to the beginning. A lower AGI may make you eligible for these tax credits. The earned income tax credit may be worth thousands of dollars if you have children. You must have income earned from work to qualify. However, investment income may lower the credit, and if it exceeds $10,000 in 2021, then you will not qualify for the credit at all. Bringing investment income to less than $10,000 may entitle you to the credit. The earned income tax credit has these AGI limits. Note the investment income limit for 2021 and 2022. The child tax credit also has AGI limits, but they are rather high. $400,000 for married couples filing jointly and $200,000 for everyone else. These are the AGI limits for the educational tax credits. The adoption credit also has rather high AGI limits. There is no AGI limit for the dependent care credit, but the credit amount does increase from 20% from those making more than $43,000 to 35% for those making $15,000 or less. For the 2021 tax year only, the size of the child or dependent care expense credit is increased and made fully refundable. The related qualifying expenses to which the credit is based increases from $3,000 for one qualifying dependent or $6,000 for two or more dependents to $8,000 and $16,000 respectively. The AGI limits for the Savers credit, which can be worth up to $1,000, determines the credit percentage, which can be 10%, 20%, or 50%, and varies with filing status. Tax loss harvesting may not work if you have only long-term capital gains or qualified dividends to offset and you are in the 0% capital gains tax bracket. Here you can see the long-term capital gains tax brackets for 2021 and 2022. The dollar amounts are the lower limits for each bracket, for each filing status, or for estates and trusts. The top bracket of 20% has no upper limit. Note that these brackets apply after deducting the standard deduction or itemized deductions plus any 20% qualified business income deduction. So, for instance, a married couple filing jointly earning more than $100,000 could still qualify for the 0% capital gains tax rate. However, even if you are in the 0% capital gains tax bracket, you could still potentially save thousands of dollars in taxes if you qualify for some of the credits already discussed. Wash sale rules exist because investors could defer or lower their taxes by selling their securities that happen to be down at the moment, then immediately repurchasing them to claim a loss for the tax year. However, if the securities are repurchased within the wash sale period, then the losses will be disallowed. The securities can be purchased outside of the wash sale period, but that introduces significant reinvestment risk. A wash sale occurs when you sell securities to claim a loss, but then you or a closely related party buys substantially identical securities within the wash sale period. The wash sale period is 61 days long, from 30 days before the date of the sale to 30 days afterwards. The wash sale rule disallows the claiming of losses for securities in a wash sale. Instead, the repurchased securities have the same basis as the sold securities, and the holding period starts when the original securities were purchased. Substantially identical securities include the same securities, or any securities convertible into the sold securities, such as call options, warrants, or preferred stocks or bonds that are convertible into the sold security. Closely related parties include the spouse, siblings, parents, grandparents, and other relatives, and also closely held corporations where the taxpayer is a major owner. Wash sale rules do not apply to retirement accounts, cryptocurrencies, or capital gains, nor to traders with professional trader status or to dealers trading as part of their business. Since wash sale rules do not apply to capital gains, you may want to sell some securities if you expect higher tax rates in the future. You can then immediately repurchase the securities for more profits in the future, but with a higher tax basis, which will be more likely to lower future taxable gains. I am now going to show you some wash sale examples for different types of transactions. I will briefly mention the type of transaction, but I will not explain it in detail, since many people will not be interested in these details. If you are interested in the details, simply freeze the screen and read the example. This is a simple wash sale example. This example shows how the wash sale rules apply to short sales. This example shows how a wash sale is treated if you repurchase these securities through your traditional IRA. As a practical matter, this treatment does not apply to Roth accounts, since the gains are not taxed anyway. If substantially identical property is bought during the wash sale period, then only the amount of loss realized on the same number of repurchased shares is disallowed. The remaining loss is deducted. If you bought blocks of securities at different times and at different prices, and sell them on the same day, and in which the wash sale rules apply to at least some of the securities, then any losses on the sale day cannot be used to offset the gains on that same day. Thank you very much for your time. If you liked my video, please give me a thumbs up and subscribe. I would appreciate any suggestions, so please leave them in the comments below. Thank you.